There's a number buried in the FDIC's latest quarterly banking report that should be on the front page of every newspaper in America. But it's not, because if the public truly understood what this number means, the consequences would be immediate and irreversible. As of the fourth quarter of 2025, small and regional banks across the United States are sitting on approximately $684 billion in unrealized losses on their securities portfolios. And for the first time since the 2008 financial crisis, a growing number of these banks are being forced to sell those assets at losses approaching 40 cents on the dollar. Let me say that again so it registers. Banks are selling assets that they paid $1 for at 60 cents. Some are selling at 50 cents. A handful are liquidating at prices that imply a 40% loss on their original investment. These are not hedge funds making speculative bets. These are the community banks, the regional lenders, the institutions that hold the savings, the checking accounts, and the small business loans of tens of millions of Americans. And when banks start selling assets at 40% losses, it doesn't stay contained. It never has. Not in 1929, not in 1987, not in 2008, and not now. But before you react, before you make any decisions driven by fear, I need you to stay with me. Because the quiet investor does not panic. The quiet investor understands the mechanics. And over the next several minutes, I'm going to walk you through exactly why this is happening, how bad it really is, what it means for your deposits and your portfolio, the critical differences between now and 2008, and the 4 defensive positions that can protect your wealth if this situation escalates. No hype, no screaming, just the truth, delivered calmly. Let's get into it. To understand why small banks are selling assets at devastating losses, you first need to understand how bank balance sheets actually work. Because most people assume that when they deposit money in a bank, it sits in a vault somewhere waiting for them to withdraw it. That is not how banking works. Not even close. When you deposit $100,000 into a savings account at your local community bank, that bank immediately takes your money and invests it. Some of it goes into loans, mortgages, car loans, business lines of credit. But a significant portion goes into securities, specifically government bonds and mortgage-backed securities. These are considered safe assets because they're backed by the United States government. And for decades, they were safe until they weren't. Here is where the problem begins. Between 2020 and 2022, interest rates were at or near zero. The Federal Reserve had slashed rates to stimulate the economy during the pandemic. And during that period, banks loaded up on long-duration bonds, meaning bonds that don't mature for 10, 20, or even 30 years. They bought these bonds at prices that reflected near zero interest rates. Then, in March 2022, the Federal Reserve began the most aggressive rate hiking cycle in 4 decades. Rates went from near zero to over 5% in less than 18 months. And when interest rates rise, bond prices fall. This is not opinion. This is the mathematical reality of how fixed income securities work. A bond that was purchased at par value, 100 cents on the dollar, when rates were at 1%, might now be worth only 65 or 70 cents on the dollar with rates at 5%. The longer the duration of the bond, the steeper the decline. Now, here's the critical distinction that most people don't understand. Banks classify their securities into 2 categories. The first category is called held to maturity. If a bank classifies a bond as held to maturity, it does not have to mark that bond to its current market value on its balance sheet. It can carry it at the original purchase price as if nothing has changed. The loss is real, but it's invisible to depositors and to most regulators. The second category is called available for sale. These securities must be marked to market, meaning the bank has to report the current value, including any unrealized losses. During the zero-rate era, small banks loaded up on long-duration held-to-maturity securities precisely because they didn't want to show the losses on their balance sheets. It was an accounting strategy designed to hide the pain, and it worked, until it didn't. Because here's the problem with hiding unrealized losses in the held-to-maturity category. The moment a bank needs cash, the moment it faces deposit outflows, unexpected loan losses, or a liquidity crunch, it has to sell those bonds. And the moment it sells even one bond from the held-to-maturity portfolio, accounting rules require it to reclassify the entire portfolio and mark everything to market. That is when a $684 billion unrealized loss becomes a realized loss. That is when the balance sheet goes from looking stable to looking insolvent. And that is exactly what is starting to happen right now at small and regional banks across the country. Let me walk you through the specific chain of events that is forcing small banks to sell assets at 40% losses. Because this is not theoretical. This is happening in real time. The first link in the chain is deposit flight. Since the collapse of Silicon Valley Bank, Signature Bank, and First Republic in March 2023, depositors have been quietly moving their money from small banks to larger institutions perceived as too big to fail. According to Federal Reserve data, Small banks have lost approximately $620 billion in deposits since March 2023. That money has flowed primarily into JP Morgan Chase, Bank of America, Wells Fargo, and money market funds offering higher yields. This deposit flight creates a vicious cycle. As deposits leave, small banks have less cash on hand. To maintain their reserve requirements and meet withdrawal demands, they need to raise liquidity. And the primary way they raise liquidity is by selling securities from their portfolios. The second link in the chain is forced selling into a distressed market. When a small bank sells bonds that it purchased at par value during the zero-rate era, it takes an immediate loss because those bonds are now worth significantly less. According to data from the FDIC and independent banking analysts, some small banks are selling mortgage-backed securities at prices reflecting 35% to 40% losses from their original purchase value. And here's what makes this devastating. When one bank sells at a loss, it establishes a new market price for similar securities. Other banks holding the same type of bonds in their held-to-maturity portfolios now face pressure from auditors and regulators to revalue their holdings based on the new lower prices. This creates a cascade effect where one bank's forced sale triggers write-downs at dozens of other banks. The third link in the chain is the regulatory response. The Office of the Comptroller of the Currency and the FDIC have been quietly increasing their oversight of small bank portfolios throughout 2025. Several banks have received confidential orders to raise capital, reduce their exposure to long-duration securities, or find merger partners. These orders are not public, but the effects are visible in the data. The number of banks on the FDIC's problem bank list increased to 68 in Q3 2025, up from 52 in Q3 2024. While the FDIC does not disclose which banks are on the list, the trend is unmistakable. The number of troubled institutions is rising, not falling. The fourth link in the chain is the commercial real estate exposure. Small and regional banks hold approximately 70% of all commercial real estate loans in the United States. And commercial real estate is in the midst of its worst downturn since 2008. Office vacancy rates in major cities are hovering between 20% and 35%. Property values have declined by 25% to 40% from their 2021 peaks. And over $900 billion in commercial real estate debt is scheduled to mature in 2026, much of which cannot be refinanced at current interest rates. When these loans default, and a growing number are defaulting, the losses flow directly onto small bank balance sheets. These banks are simultaneously losing deposits, selling securities at steep losses, and absorbing commercial real estate loan defaults. The combination is creating a slow-motion crisis that looks nothing like the sudden panic of 2008, but may ultimately be just as destructive. Now, let me address the comparison to 2008 directly, because this is where intellectual honesty matters most. The quiet investor doesn't make lazy historical comparisons for clicks. The quiet investor examines the similarities and the differences. Here are the similarities that are genuinely concerning. First, both crises involve asset-liability mismatches at financial institutions. In 2008, banks held mortgage-backed securities that were worth far less than their balance sheet values. Today, banks hold government bonds and mortgage-backed securities that are worth far less than their balance sheet values. The underlying assets are different, but the mechanical problem is identical. Banks owe depositors 100 cents on the dollar, but the assets backing those deposits are worth significantly less. Second, both crises feature a cascade dynamic where forced selling by distressed institutions depresses prices, which triggers more distress at other institutions. In 2008, it was the fire sale of subprime mortgage securities. Today, it is the fire sale of long-duration treasury and agency bonds. The cascade mechanism is the same. Third, both crises were preceded by a period of artificially low interest rates that encouraged excessive risk-taking, followed by a rapid tightening cycle that exposed the vulnerabilities. In 2008, it was the Greenspan easy money era, followed by rate hikes in 2004 through 2006. Today, it is the pandemic zero-rate era, followed by the aggressive hikes of 2022 through 2023. Fourth, both crises disproportionately affect smaller institutions. In 2008, it was the regional banks, the mortgage lenders, and the thrifts that failed first. Bear Stearns and Lehman Brothers were large, but the majority of the 465 banks that failed between 2008 and 2012 were community and regional institutions. The same pattern is emerging now. Now here are the critical differences, and these differences matter enormously for how this plays out. The first difference is the quality of the underlying assets. In 2008, the toxic assets were subprime mortgages, loans made to borrowers who could never realistically repay them. The assets were fundamentally worthless. Today, the assets causing losses are United States Treasury bonds and agency mortgage-backed securities. These are not worthless. They will pay their full face value at maturity. The problem is not credit risk, it is duration risk. If a bank can hold these bonds to maturity, it will get its money back. The crisis occurs when banks are forced to sell before maturity. This is an important distinction because it means the losses are theoretically recoverable if given enough time. In 2008, the losses were permanent. Today, the losses are real but potentially temporary, provided banks can survive long enough to hold their securities to maturity. The second difference is that the Federal Reserve now has tools that didn't exist in 2008. The Bank Term Funding Program, created during the March 2023 banking crisis, allows banks to borrow against their securities at par value rather than market value. This effectively provides a lifeline that prevents forced selling. However, the BTFP was scheduled to expire, and its extension into 2026 suggests that the Fed knows banks still need the support. If the program is allowed to expire without a replacement, the forced selling dynamic could accelerate dramatically. The third difference is the FDIC deposit insurance system. After 2008, the Dodd-Frank Act expanded regulatory oversight and increased the FDIC's resolution authority. The FDIC now has more tools to manage bank failures in an orderly fashion. However, the Deposit Insurance Fund currently holds approximately $129 billion, which covers only about 1.15% of insured deposits. If multiple mid-sized banks fail simultaneously, the fund could be overwhelmed, requiring either a special assessment on surviving banks or direct government intervention. The fourth difference is the political environment. In 2008, there was bipartisan support for bank bailouts, however unpopular they were with the public. Today, the political appetite for bailouts is virtually zero. Any politician who votes to bail out banks in the current environment faces near certain backlash from voters on both sides of the aisle. This means that if the crisis escalates, the government's ability to respond quickly may be constrained by political dynamics that didn't exist in 2008. Here is my honest assessment of where we stand, and I want to be very measured about this. I do not believe we are heading into a 2008-style systemic meltdown. The quality of the underlying assets is better, the regulatory tools are stronger, and the Federal Reserve has demonstrated a willingness to intervene when necessary. But I do believe we are in the early stages of a slow-motion consolidation of the American banking system that will result in dozens, possibly hundreds, of small bank failures over the next 2 to 3 years. The economics of small banking in a high-rate environment with declining deposits and deteriorating commercial real estate portfolios are simply not viable for many institutions. This is not a crisis that will unfold with the sudden violence of September 2008 when Lehman Brothers collapsed and the global financial system nearly stopped functioning. This is a crisis that will unfold quietly, one small bank at a time, one FDIC receivership at a time, one Friday evening press release at a time. And that quiet unfolding is actually more dangerous for the average person, because there will be no dramatic moment that forces you to pay attention, no Lehman moment, no TARP vote, no presidential address, just a slow, steady erosion of the institutions that hold your money, process your transactions, and fund your community. The quiet investor pays attention to the quiet crises, because by the time they become loud, the exits are already crowded. So here are the 4 defensive positions I believe every investor should consider right now. The first position is to ensure your deposits are fully insured. This sounds basic, but it is the single most important step you can take. The FDIC insures deposits up to $250,000 per depositor, per institution, per ownership category. If you have more than $250,000 at any single bank, you are an unsecured creditor for the amount above that limit. In a bank failure, unsecured creditors can lose some or all of their uninsured deposits. The solution is straightforward. Spread your deposits across multiple institutions so that no single bank holds more than $250,000 of your money. You can also use joint accounts, trust accounts, and retirement accounts to increase your effective coverage at a single institution, since each ownership category qualifies for a separate $250,000 limit. Consult the FDIC's electronic deposit insurance estimator on their website to calculate your exact coverage. If you bank with a small community or regional bank, take the time to review their financial statements. Look at their Tier 1 capital ratio, their loan-to-deposit ratio, and their exposure to commercial real estate. These are publicly available metrics that tell you how healthy your bank is. If the numbers don't look strong, consider moving some of your deposits to a larger, better capitalized institution. The second position is to hold physical cash reserves outside the banking system. I am not talking about burying money in your backyard. I am talking about maintaining a reasonable amount of physical currency in a secure location that you can access if your bank experiences a temporary disruption. During the Silicon Valley Bank collapse, depositors were locked out of their accounts for days. Businesses couldn't make payroll. Individuals couldn't access their savings. Having 2 to 4 weeks of essential expenses in physical cash ensures that a banking disruption doesn't become a personal emergency. This is insurance, not investment. You're not trying to earn a return on this money. You're ensuring that you can feed your family, fill your gas tank, and pay essential bills if the electronic payment system experiences a hiccup. The third position is to allocate a portion of your portfolio to assets outside the banking system. Physical gold and silver, as we discussed in my previous video, are the most direct way to hold wealth outside the financial system. They have no counterparty risk, no dependence on any single institution's solvency, and a 5,000-year track record as stores of value. But beyond precious metals, consider Treasury bills purchased directly through treasurydirect.gov. When you buy T-bills directly from the Treasury, your money is held by the United States government, not by a commercial bank. Short-term T-bills, currently yielding in the 4% range, provide both safety and reasonable returns while removing your exposure to the commercial banking system. Money market funds invested in government securities provide another layer of protection. These funds hold short-duration government debt and are not dependent on any single bank's solvency. However, be aware that money market funds are not FDIC insured, so choose funds from large, well-established providers with strong track records. The fourth position is to avoid panic and position for opportunity. This is the most important point, and it is where the quiet investor separates from the crowd. Banking crises, however painful, create extraordinary investment opportunities for those who are prepared. When small banks fail, their assets are sold at deep discounts. Their healthy loan portfolios are acquired by stronger banks at bargain prices. The surviving banks that absorb these assets at distressed valuations often generate exceptional returns for their shareholders in the years following a crisis. After 2008, investors who bought shares in well-capitalized regional banks at the bottom earned returns of 300% to 500% over the following 5 years. The same opportunity will likely present itself in this cycle. The key is to identify the survivors, the banks with strong capital ratios, conservative lending practices, low commercial real estate exposure, and stable deposit bases. When the weak banks fail and their assets are distributed, the strong banks will feast. And the quiet investor wants to own the survivors, not the casualties. Build a watch list now. Track the financial metrics of the banks you're considering. And when the market gives you the opportunity to buy quality banking assets at distressed prices, be ready to act. Fortune favors the prepared. Here are the 4 specific indicators I'm monitoring to gauge how this banking situation evolves. First, watch the FDIC's quarterly banking profile. This report, published roughly 2 months after each quarter ends, contains detailed data on unrealized losses, problem banks, and deposit trends. The next report, covering Q4 2025, should be released in late February or March 2026. I will break it down for you when it drops. Second, watch the Federal Reserve's H8 report, which tracks weekly changes in commercial bank deposits. If deposit outflows from small banks accelerate, the forced selling dynamic intensifies. This is a real-time early warning system. Third, watch the Bank Term Funding Program utilization. If usage increases, it means more banks are coming to the Fed for emergency liquidity. If the program expires without renewal, the safety net disappears and small banks lose their lifeline. Fourth, watch Friday evenings. The FDIC typically announces bank failures on Friday after market, close to allow the weekend for resolution. If you start seeing Friday evening announcements with increasing frequency, the quiet phase of this crisis is ending and the loud phase is beginning. I'll be tracking all 4 of these indicators and updating you as the data develops. Here's the question I want you to answer in the comments, and I genuinely want to hear from you. Do you currently bank with a small or regional bank? And after watching this video, are you considering moving any of your deposits? I'm not asking this to create panic. I'm asking because the collective experience of this community is genuinely valuable, and I want to understand how people are thinking about this risk in real terms. I read every comment on this channel. The discussions here are consistently among the most thoughtful and well-informed I've found anywhere on this platform, and your perspective helps all of us navigate these uncertain times with greater clarity. If this analysis helped you understand a complex situation without the noise, without the screaming, and without the manipulation, then I need 2 things from you. First, subscribe and turn on notifications. This banking situation is developing in real time. The FDIC data I mentioned is dropping soon, and I will be here to break it down for you with the same depth and balance you got today. Second, share this video with someone who keeps all of their money at a single bank and has never checked whether their deposits exceed the FDIC insurance limit. You might be the reason they protect themselves before they need to. The quiet investor doesn't wait for the crisis to arrive. The quiet investor sees it forming, understands the mechanics, and positions accordingly. While the crowd panics, the quiet investor prepares. While the crowd reacts, the quiet investor has already moved. Stay quiet, stay informed, stay invested. I'll see you in the next one.